Hey, so I thought I'd start out this with a quick video talking about what are the personal accounting and financial statements actually. So we'll go over them a little bit before we make them so that you know what they are about. This is a handout that I made, kind of like an informational handout. It's about the personal financial accounting statements. They're easy. They're very easy, guys. If this scares you, don't let it. Like, I think one of the biggest problems with personal finance is that we think it's a lot harder than it actually is. It's really very simple when you get down to it. So let's walk through this, okay? There's three statements that I got to get out of the way here. There's three documents that we concern ourselves with, right? The first is the income statement. Blah. Thing like that. The income statement is a summary of income and expenses. So what we saw in the last video right there in YNAB, that is basically an income statement, except there's a expense category that tracks transfer from one account to another in investment. Not really income. That's something that was going to go onto the cash flow statement. The cash flow statement shows how cash actually moved in and out of your accounts over a period of time. Okay, we're going to talk about what the difference is between the income statement and the cash flow statement because they're often mixed up. The balance sheet is something that we already made before. It's just a list of assets and liabilities. We made that in one of the very first videos that we did. I'd like to say that even if you don't have these statements in an Excel sheet or on paper, or if you don't have them, like, I asked people who has these statements or who does not have these statements, right? And some people will raise their hand. That's wrong. That's incorrect. Every single person has these statements because all these statements are just descriptions of what's going on. Now, it's kind of like cancer, okay? I'm going to liken it to cancer, all right? You go to the doctor one day and they say, okay, we're going to do a screening for you. And then the doctor said, they do all their tests and everything like that. They put you into the machines. And then the doctor says, oh, you have cancer, all right? So let me ask you, when did you get cancer? Did you have cancer when you went to the doctor and the doctor told you you had cancer? Or did you have cancer sometime before, maybe for a year or 2 years? You had cancer at some time before. All the doctor did was show you, hey, you have cancer. So there was a certain period of time where you had cancer, but you didn't know that you have cancer. It's the same thing with these statements. You have an income statement, you have a cash flow statement, and you have a balance sheet. If you're not looking at them, they're probably going to be your worst enemy. But if you want to look at them, what we're going to do in this series here, then they become your best friend. And that basically sums up the relationship that you have with these three documents. So let's take a look at the income statement a little bit deeper. The income statement, it's a summary of all income and expenses. It is captured over a period of time. So the income statement for June, for example, is going to be all the income received during the month of June and all the expenses taken out during the month of June. And it's just easy to do it over months. Like, you can do it whatever period of time you want. It's really arbitrary. It's up to you. But the month is a pretty convenient time frame to choose for this period. Like, you can choose 15 days or 2 weeks if you want. Like, I think I've heard some people doing this weekly because they are really living paycheck to paycheck, and every single week they got to make sure that they're in the green. But most of the time it's going to make sense to do it monthly. Once you have a full 12 months of income statements, then you can just consolidate it into a yearly income statement. So you can keep track of it year over year as well. Okay, so it's very easy, right? It's just all the income that you got. It's usually going to be your salary if you made any other money from doing anything else, or an interest in the accounts. You're typically going to want to put the taxable income on your income statement. It's not something that you have to do. I like doing that just because that's how I know how much of my income is going to be taxed or was taxed at the end of the year. If you sell something, like, for example, if I sell something on OfferUp or on Craigslist or something, I could put it into the income category there, but when I do that, I don't actually put it as income because I bought that thing a while ago, Well, let's take my car, for example. That's a relevant example right now. So I bought my car for $19.95, okay, and then I kept it, I drove it, and that kind of thing. When I sell that car, whatever I sell it for is not really income. It's not really income. Like, let's say I sell the car again for $19.95. That's considered to me a car expense, because when I bought the car, I put the car purchase into the car category. So when I sell the car, that's going to go into the car category. And it's the same thing with like other stuff. Like, let's say I sell a water bottle. That's going to go into the other category or something like that, right? So that's how I mean, that's just my way of thinking about it. You don't have to do the same thing. If you want to put income in there of like, hey, I'm going to go on a selling spree and sell a bunch of stuff, and I want to track that way, you can do that. But I like to capture that in my cash flow statement. We'll go over that in a second. Okay, so for the expense side, all the things that you paid for. So there's two ways to do this income statement, right? And it's up to you. For simplicity's sake, I kind of like to just put the after-tax income here. But to really, really get a picture of what the heck is going on with your money, then I encourage you to add taxes to the expense side of the table, because then you're going to start to see how much taxes actually affect your income. It's going to require a little bit extra work on our end, but you get to see, like, taxes eat up a lot of... Taxes are probably your biggest expense. Probably your biggest expense after rent or housing. Okay, so that's pretty simple. The output of this statement is the net income, and this tells you whether you're making or losing money for that month. Did you have positive or negative income, net income for that month? Okay. This net income goes in as the first entry on the cash flow statement right there. Okay. So the cash flow statement differs from the income statement is that it's how the cash actually moved. So in my case, we'll look at this later on, but I think for June I'm going to have a negative cash flow, but I'm going to have a positive net income. How is that possible? All right, well, we'll get into it. So an inflow of cash is all the, and this is also captured over a period of time, by the way, same as the income statement. So inflows of cash are net income, new debt, gifts, and any other way that money came into your accounts. Okay, a big one is going to be new debt. Like, let's say, for example, you bought something with a credit card and you only pay the minimum payment. Okay, remember how credit cards work. When you make a purchase on a credit card, the bank pays for it. So essentially the bank is giving you $1,035 to pay for the expense. If you only pay $35 onto that expense, then for outflows, your debt payment is $35, right? Your new debt that you got is $1,035, and you pay off the debt $35. That's your outflow. And then you could end up, if that's your only cash flow that's happening, then you end up with a positive net cash flow. Okay. So typically outflows are going to be things like, how much did you pay down to your debt? Did you invest that money? Goal allocation, whatever. I mean, it's where the cash flow went, or it's where the cash went. The output of the statement is the net cash flow. And ideally, you want to get this as close as you can to zero. Or if you have an excess of cash that you want to deploy into investing or goals or paying off debt, then it should be negative. If it's positive, that means you have cash that's not being allocated to something. And the cash is essentially like in limbo. I don't know what to do. I don't know what to do. I'm just going to sit here. And if it's sitting there in a bank account, a checking account, a savings account, a money market account for extended periods of time, that cash is not being utilized to its fullest potential. So the outflow of the cash flow statement is net cash flow, and that doesn't go into the balance sheet, but it describes how the balance sheet changes. So we know what a balance sheet is already. It's a summary of the assets and liabilities. It's captured on a point in time. So it's not captured over a period. It's captured at a point in time. So when we make our balance sheet, it's going to be June or July 2nd, 2020 at 11 a.m. So list of all the assets that you got and the liabilities, right? So the net cash flow is a description of like where the money went into the balance sheet. And all of these accounts are all interrelated. They're all connected. What happens on the income statement affects the cash flow statement, which affects the balance sheet, which then affects the income statement. It's not like it ends on the balance sheet. And that's a key concept that many people don't understand. Balance sheet, assets and liabilities increase your income or increase your expenses. If you have a lot of liabilities, you're going to have more expenses. We see this as an example on credit cards, right? I'm paying credit card interest, and that's an expense. That's a discretionary expense for me. However, if I invest in assets, if I take the money that I get from my net income into my cash flow statement and then allocate that, outflow it into a investment account, for example, that investment account can pay dividends to me, and that becomes income. The income increases my net income, which then I can use as an inflow, which becomes the inflow of my cash flow statement. Then if I outflow that smartly to an asset, an investment account, or whatever, a cash flowing asset is what they call it, then that will produce more income for me. You see how this works. The other way, and what most people end up doing, is that they get their net income and then they outflow it to stupid stuff. They outflow it to liabilities, basically. And then the liabilities create more expenses. Like, for example, oh, I got a raise. I'm going to go buy a new car. So you take on new debt. All right, that means you have new debt payments. Okay, now you have a liability on your balance sheet. And that liability is going to create more expenses for you. So that's what I mean when I say that these statements are either your best friend or your worst enemy. Probably, if you're not looking at them, they're your worst enemy. But they exist. They exist anyway. Doesn't matter whether you have them or not. Now the next thing that we're going to do is create these. We already created the balance sheet, so next we're going to create the income statement and the cash flow statement. Okay? And if you want a summary of what we just talked about, I'll let you read this. Alright guys, see you in the next video.